Hello and good afternoon, ladies and gentlemen. Welcome to today's virtual non-deal roadshow. My name is Noella Alexander Young, virtual event moderator here at Renmark Financial Communications. On behalf of our team, we'd like to thank everyone in Atlanta and surrounding areas for joining us today for the presentation of Silver Crown Royalties, trading on the CBOE under the ticker symbol SCRI and on the OTCQX under the ticker symbol SLCRF. Presenting today is Peter Burris, founder, chairman, and CEO. With that being said, I will now hand it over to Peter.
Thank you to everybody that's joining us on the call today and dialed into the presentation. I'm going to start out by telling you a little bit about myself. We're relatively new, and it's a new area for us, Atlanta, so perhaps quite a few of you don't know who I am. So I am the CEO of Silver Crown Royalties, but prior to this, I started my career as a mining engineer. I worked at Placer Dome, Canada for a number of years. I transitioned into the financial sector in the late 90s, early 2000s, and I spent a lot of time in research covering royalty companies, covering base metal companies, covering silver companies, as well as spending some time on the buy side, investing in various types of companies, mining companies, royalty companies, etc., but always on the natural resource side with very much a slant towards hard rock resources, metals, and mining. Silver Crown was founded about 3-4 years ago. We took it public about 1 year ago, just over 1 year ago in July of last year. And there's a chart that I'll speak to in here that talks to the history of the company and what we've accomplished and what's reflected in the share price today. Silver Crown, as the name implies, is very much all about silver. So why did we choose silver? Well, the key for us getting exposure to silver is because it maintains purchasing power through time. And that is what we found, interestingly enough, historically. So there is a historic relationship between silver price being able to maintain its purchasing power through time and the growth of debt, specifically the United States debt at the federal level. Theoretically, that makes sense. That is used as a basis for all the leverage, all the credit that is outstanding, not just in the United States, but through the entirety of the global banking system everywhere. So it stands to reason, and it theoretically makes sense, that if you issue $1 of debt at the federal level in the United States, ultimately there is so much leverage and so much credit that has pumped through the system that the purchasing power of the US dollar, and in fact all fiat currencies, should decline by some rate. Interestingly enough, we were able to run statistical relationships looking back, and we found that roughly 80% of silver price moves can be explained away by the expansion of the balance sheet of the Fed in the United States. So what that means is that this model implies $90 per ounce silver in 28, and when the debt hits 50 trillion, silver should be somewhere around $100, $110 per ounce. What this also shows us, which is kind of an interesting feature, is that if we can quasi-accurately predict debt levels, which are really related to time, the longer there is time, the more debt the United States issues. That's just the way that it is. We can determine whether or not the silver price is running ahead of where it should be based on the debt growth and the amount of debt that is being added into the system. So what this chart shows is very simply a relationship between the projected silver price and whether or not it's trading 2.5 sigma outside that projected range. And we recently did see that when silver hit $54. It gave not necessarily a sell signal, but certainly a reduced signal, or another way to look at it, a more cautious approach to investing in silver, in precious metals at that particular price point. Now, since then, we've had silver decline to $47, $46, and coincidentally, that is the implied price, again, by the debt growth that we've seen recently in the United States. So we are now at a low risk entry point, in our opinion, into the silver space. So if we're going to be building a position, we certainly don't think that we missed anything, and we're certainly of the belief, based on this information, that we are not overpaying. We are not chasing here. We are entering a position at the right time. Even though the silver price may seem very high relative to where it's been historically, it's not outside of the norm of where it theoretically should be based on what the US balance sheet looks like. So we like silver. We think this is a great entry point into the silver space. Why Silver Crown? So there's a lot of different ways to get exposure to silver. One of them is the metal itself. You can simply buy and trade the metal on a futures exchange, or you could buy physical and keep it in a vault or what have you. Unfortunately, you don't get any kind of a return other than price appreciation. So there's no dividends, there's no organic growth. That 1 ounce doesn't turn into 2 ounces. With an equity ETF, you simply have a collection of products that are equities, and these are not necessarily silver miners. We just saw recently Coeur d'Alene and New Gold merge, and this is going to create one of the bigger gold miners. Coeur, I mentioned Coeur d'Alene, it's actually called Coeur, Heart of Silver. Well, they're no longer a silver producer, and especially after this transaction, they're a gold producer. What I'm trying to get at is that there's very few, if any, pure silver producers out there. So an equity ETF will mostly have gold producers in it. And there's going to be, from an economic perspective, more than half revenues come from other metals, not silver. So that's another thing which kind of left this room for us to create a pure silver product. Royalty companies, again, mostly focused on gold. Metal ETFs, again, those won't pay you a dividend. So with Silver Crown, we essentially established this company to be a royalty company, and I'll explain what that is in a second. What we're building is a yield product, and I keep talking about dividends and having some kind of return. We're building a yield product that's backed by physical silver. So unlike treasuries, which are simply backed by the tax power of the United States government, for instance, and they pay dividends in fiat, well, what we're building here is the yield product that pays dividends essentially in silver. So the purchasing power through time going forward is maintained. Royalty companies, why do we like them? So here is a case study of a royalty company called Wheaton Precious Metals. So Wheaton Precious started its life 20 years ago, 21 years ago, as a silver streaming company. And its name was Silver Wheaton for that reason. Now, about 5-6 years ago, the company changed its name to Wheaton Precious Metals because it became predominantly a gold by revenue company. What we show here in the top line is simply the share price performance of Wheaton Precious Metals. So you're looking at roughly 25% annual return ever since the company went public 21 years ago. I mentioned here that Goldcorp sold its remaining stake of 30% in the company 5 years later, which would have been right around here. They sold it for $1 billion. So originally, when Goldcorp got involved, obviously that number was a lot lower, but what we're trying to show is the return capabilities of a royalty or streaming type company. It's outperformed the silver price by 15-fold. That's this gray line here. So that's, a much better strategy than simply holding the metal. Is holding the royalty company. And for comparison, we talked about producers shown here on this chart, this gray line at the bottom, that's simply Newmont, and that's a randomly chosen producer. I could have picked Barrick just as well, divided by the price of gold. It's actually underperformed a buy and hold strategy of just holding the metal itself. Now, I'm by no means trying to say that you cannot make money with producers. Of course you can. But if it's a buy and hold strategy, it will generally underperform over the course of the cycle. There are exceptions as always. However, with royalty companies, the chart very much is similar to this. And that's what we're trying to emulate with Silver Crown. Another case study is Franco-Nevada. Now, Franco is still trading. It's out there, but I like to call it Franco 2.0. So Franco had two distinct lives. The first one was from 1982 to 2002, and the very first parts of the 1982 timeframe are shown here. And what we've done is we've simply looked at Franco-Nevada and its revenue generation from when it first started generating revenues, which was in their year 5, year 6 of existence, up until a number of years later when they went from $500,000 Canadian to $3.5 million Canadian. And these are not random numbers. They're actually an interesting coincidence because for us, we generated $500,000 in revenues last year, and we're expected to make $3.5 million in revenues next year based on various assumptions. And yeah, there's forward-looking statements at the front end. But bottom line, based on our partners and the royalties that we have in hand right now, this is the number that we would expect. The gray line here simply shows Franco-Nevada's market capitalization going from roughly 30 million when they recorded their first revenues. Now we're at about 20 million. So relative to where they were at that point in time, relative to where we are at the current point in time, I will argue that we're inexpensive. And I'll get into that later as well. I think that this particular stock right now is trading at about a 50% discount to where it should be, simply related to the rest of the market, not just to where Franco was trading 40 years ago. But you can see that there's a potential for revaluation here as we book those revenues going forward over the next 12 months. Franco is a very interesting case because their cumulative average growth rate was 41%, which is better than, I believe, even Buffett's performance over that period of time. But essentially, what Silver Crown is doing here, or what this company that we're building here is allowing investors to do, Wheaton Precious Metals, when they IPO'd, that was a several hundred million market cap company, and that was 25 years ago. You would have to go back 40 years to be able to see a company that was less than 100 million market cap when it first started getting into a significant amount of revenues, when it became self-sufficient on a free cash flow basis. So Silver Crown Royalties is essentially the first ground floor entry point into a royalty company business model in the last 40 years. In other words, if you missed Franco 40 years ago, here's another chance to do it. But that chance did not occur with Silver Wheaton because it was already priced very richly in terms of size, not necessarily in terms of multiples, but in terms of size when it went public. And same with Franco-Nevada when it went public the second time as a 1.5 billion market cap company in 2008. So we're about 20 million right now. Very, very ground floor entry point. For those unfamiliar with royalties, very simply, we take fiat cash money at the front end, we pass it on to the producer, and now the producer delivers to us silver or pays us in silver equivalent as long as they're operating. And that can work for not just mines, for instance, but it can also work for various types of facilities. It could be a recycling plant, it could be a smelter, it could be any other type of silver producer that is not a mine. So here's a summary of what royalties and streams are and how we're a little bit different. So I might have mentioned that I was an analyst looking at royalty companies for a better part of my career. So I felt that there were a couple of things that perhaps a royalty company could improve on, or at least certain opportunities that were kind of on the table that were not being actively pursued, other than the single mineral approach, which, you know, outside of Silver Wheaton 20 years ago, nobody really had, and certainly does not have today. I thought that was a great place to focus, especially on a mineral that not everybody else is actively pursuing or is not at the top of their priority list. For us, that's the only element that we're looking at. It's the only one that we will ever do deals on. The other thing that we kind of thought about was, well, if we're going to give a producer money, we probably want it back. We want some level of certainty. We almost want this to be almost like a silver loan. So what we want to be able to do is create value for our shareholders from that transaction by being able to go back to them with some kind of a minimum delivery payment structure. And this also allows us to create value from byproduct, co-product that is not reported. We'll get into that in a little bit, but the bottom line here is that because of our approach, we can now structure transactions where other royalty companies can't. Royalties are registered on title, which is more beneficial than streams, which are more or less a debt instrument. These are little nuances that we also considered while attempting to improve on the royalty business model. We've also taken very much an investment approach. And what I mean by this is not only do we create single element royalties, but also we try to put in revenue safeguards, very much like a portfolio manager would. They try to make sure that the investment, their capital deployment, is going to generate returns for their investors. So they try to put in as many safeguards as possible. And with the minimum payments, I think we've accomplished that. Another approach that we have is very key is diversification. In the mining space, every project has risks, and there's absolutely nothing that can be done about them. And we can go beyond just politics and geology and metallurgy. It can be an environmental risk. And I'm not talking about NGOs, I'm talking about a typhoon. And these do happen. So projects will run into problems, and that's more or less a guarantee, unfortunately, in this business. So diversification is a key approach to us. We have 5 royalties right now. Ultimately, we want that to be several hundred so that no single royalty can have so much negative impact on us that our yield product business model goes by the wayside. With the minimum deliveries, we're now able to go after infrastructure, which is unlike other royalty companies so far. They've not been focusing on things like mills or smelters or refineries, recyclers, etc. So the secondary producers of silver, essentially, as it were, not just the mines. And in terms of the project impact, we try to keep it as unobtrusive as possible. Less than 2% so far is the types of transactions that we've done in terms of a revenue basis. We find that if there's too much of an economic impact from the royalty partner, so from somebody like us to the operator, the economic benefits shift from the operator to the royalty, and there's very little incentives for the operator to actually do something. Some of the incentives that we've layered in, staged deployment, meaning that we have milestone payments, so we want to incentivize the producer to produce more silver, to get permits, to expand production, find more ounces, things of this nature. So each one of these milestones will be rewarded in the deal structures that we propose. There's bonus payments, again, for increased production, exploration success. And we attempt to utilize our equity more so than our cash to align further the operator with us. If they succeed, that means our share price goes up. If our share price goes up and they're a shareholder, their shareholders benefit as well. In terms of what's in the portfolio and the pipeline, so I talked about how we structure transactions, and we're essentially the first ones really focusing only on silver as royalties. And this has given us the opportunity to structure transactions that are returning more than 25% on each individual basis. And usually we target 25 to 30%. And on this list, you can see that the overall portfolio is a 26% return on invested capital for each one of those at the project level. In terms of the pipeline, there's 2,400 operating mines that have silver byproduct or co-product. There's over 30,000 exploration projects. There's countless recycling, reprocessing facilities. Essentially, what I'm trying to get at here is that the market is, in terms of time and in terms of effort, even if we had a tremendous team in terms of size, we still would not be able to address even 1/10 of these in our lifetimes. So there is a massive pipeline of projects that we can transact on. And speaking of which, the pipeline has at any given point 10 active discussions. And in fact, even today, we advanced one of those. We've averaged 2 royalty additions to the portfolio a year since we started. So again, we now have 5. We're kind of due for one. So, maybe I'm dropping some hints here, but look, we're always in discussions. And if we do get to a binding or a definitive agreement, we would be announcing that, obviously. Right now, where we are is tier 1 jurisdictions, just sticking to the Western Hemisphere. No funny places, no Venezuela, none of this controversy until we get to free cash flow positive. But we will always, because of diversification, we will always be very cognizant of how much exposure we want to risky areas. We'll be looking for higher returns, and we will be committing a lot less capital as a percentage of the whole into more dangerous places. So this is where this is what we've done since we've been public. What the blue line shows is our market capitalization divided by the silver price. So has Silver Crown added value, or has it not added value relative to just holding the metal itself? So this chart shows you that since we went public, there were a number of occasions when we didn't, and a number of occasions when we did. I can go in depth as to what's happened here, but bottom line, the C line or the C move is basically discounting everything in the share price, all the good, all the bad, all the deals, everything, and essentially hitting reset in terms of putting cash on the balance sheet, which is what we've done by closing a transaction at the start of last month, so in October, and securing enough royalties to get ourselves to free cash flow. So all of that is out in the market now. And as we now continue to advance discussions, and as we now show the results from the various royalty partners that we have, hopefully the share price is now looking at a re-rating. In terms of re-rating, well, I'm a believer in that the stock is underpriced. So the little triangles here, that's me buying stock. Pretty much every time we're not restricted, I'm adding to my position, which is now close to about 9%, 8.5%, 9% of the company. The gray line is a little tough to see, but that's price to sales of Silver Crown Royalties. And of course, the blue line, that's our share price in absolute terms. So we're basically at the low end of our 52-week trading range. And again, I think that this is a great opportunity to enter the trade right now. And in terms of price to sales as well, we're trading around 14 times, and the range is 12 to 25 over the last year. And again, I think that this is a tremendous opportunity to enter the trade right now. In terms of price to sales relative to peers, well, peers right now are trading at 44 times sales. I think that's a little lofty. Again, having analyzed these companies, looking at royalty companies for a number of years, 20 times, 25 times would be kind of a logical place to be in terms of sales. If you have a 90% margin, that's kind of 25, 30 times free cash flow, which in this interest rate environment we can defend. But bottom line is, I think that not only is there potential to re-rate to a higher range of the multiples, but the multiple itself. So between 20, 25 times sales, there's very much a justification for Silver Crown to trade significantly higher than where it is right now. Now, we do expect that re-rate to occur as PPX and our other royalty partners start providing additional revenues to us in Q1 next year, Q2 next year. So we've accomplished material silver delivery growth over the last few years. Again, since we started zero, last year was 15,000 ounces. This year we should do somewhere around 22, 25,000 ounces-ish. Obviously, in terms of sales, that number is going to be higher than it would have been in 2024 by a significant amount, simply because the silver price is going to be helping us quite a bit here. Going into next year, we'll be looking at 43 to 62,000 ounces, just based on what we have in hand right now. This does not include any of the pipeline projects, of which, like I mentioned, there's between 10, there's more than 10 at any given point. The silver market is huge, 1 billion ounces. There's half of it we believe is reported, the other half is unreported. We can focus on the unreported side simply because we have the minimum deliveries. If we target 0.5% of the entire market, that's 5 million silver ounces a year. That would put us in a 5+ billion market cap range. Now, that's not what is shown in this table here. The only thing that's shown in this table is a reflection of this chart. So again, what we fully expect our revenue base, the silver ounces, what we expect them to be next year, multiplied by 20 times sales, and that's simply the low end range of peer multiples. Using a spot price of 48, we're at 47.60, so that's pretty close. Stock should be somewhere between $13, $21 in Q2 next year as we advance through this. Now, I will caveat this with one thing, and maybe even if I go back here a little bit, well, what happened in the B curve here, or in the B part of this, is we were adding royalties. So I believe that if we announce another royalty, the stock could get re-rated at that point in time. So not only do I anticipate a re-rate as we enter free cash flow second quarter next year, but if we do announce a cash generating royalty sometime in the next 8 weeks, 10 weeks, whatever the time frame may be, could be next month, who knows, there could be a re-rate associated with that as well. In terms of capital structure, very tight, 3.8 million shares out. There's no penny stock, no nickel stock. Founders were purchasing stock at $1. We're trading about $5.50, $5.60 right now. So again, there's quite a lot of alignment there, I would argue. And in terms of ownership, we do have retail at 49%, but a lot of that is very sticky. We have two quite important institutions, Euro Pacific, that's Peter Schiff and Adrian Day. US Global's got 3%. So that's institutions. They've been good supporters for us the last year, year and a half. We don't think that they're sellers. And then there's, of course, management, and that's myself, CFO, a number of the directors, etc. So between quite a limited number of shareholders, more than 50, 60% of the stock is held in very, very, very tight hands. And with that, I'll close off and leave it open to questions. Please, Noella.
Thank you very much, Peter, for the presentation. We will now begin the Q&A. Your first question is, the company announced a deferred commencement for minimum royalty payments in one agreement. What specifically triggered the deferment? What is the new contractual commencement date? And what are the conditions that would make the deferred payments start earlier?
Right. So I believe that that's referring to Pilar. And Pilar, very simply, they do have an obligation to pay us 4,000 ounces per quarter. Now, that mine has gone into essentially a restructuring in terms of operations at the beginning of this year, and they have been therefore deferring payments to us. So even though under IFRS we can book the revenues, they show up as deferred revenues on our balance sheet as part of the current assets. They are obligated to pay us every quarter. And of course, if they can't, then we sit down with them and we say, okay, when will you be comfortable paying us again, etc. They have paid us before, so we do have some comfort that they will pay us again. But much more importantly, there has been quite a lot of restructuring in terms of management, especially in Brazil with that project. And we feel a lot more comfort now than we probably ever did. That the payments will resume, if not this quarter, then in Q1 next year. But we do fully expect to recover all of those payments, and they will become current when the mine restarts. There are certain permits that need to be had, etc. But we believe that that mine can restart in Q1 of next year. As well, the company has raised a number of funds, which we could arguably ask them to use to pay us. However, we would feel a lot more comfortable to see the mine restart and us getting paid from their operational revenues than getting paid from money that they raised, just in case they need that money to, make sure that operations are going well.
What is management's policy for using equity versus cash to acquire new royalties?
We would always prefer to use equity, and that's for two reasons. One, it's very difficult to raise equity in the market still to this day. A part of that as well is that if you raise equity in the market, you have to do it in the context of the market, right? Your stock's at $6, you can't raise equity at 10. Whereas if we simply do an equity transaction with an operator, we can name the price, something that we both agree on. And we've done that in the past. So for instance, when we did the backdeck transaction, that was a $10 a share deal. And we were trading at $7 at the time. So raising money in the market, we would have been at a 30% discount to the price that we actually used. And another component of the second part is it's a lot easier, it's a lot timelier to use equity on a essentially swap basis than it is to go out and raise the money, because that's a time-consuming process. It will take anywhere from a month, 2 months, 3 months, depending on the market. Whereas if you simply do a treasury issue, well, that can be done more or less immediately.
What does the deal landscape look like going into 2026?
Surprisingly, really good. I think that producers are beginning to appreciate the ability of utilizing Silver Crown as a corporate partner and Silver Crown's equity to not only unlock value of their silver, which again, we estimate half the time is unreported altogether. So it's not like the market is going to pay them for something that is, as far as anybody's concerned, in the public domain, not really there. And they can utilize that equity as well in the future, not only because we intend to pay a dividend, so obviously that can come back to them in the source of revenues, but also, if there's a revaluation like we anticipate, obviously they can go and crystallize some of the value by selling a portion of it, very much like what Goldcorp did with Silver Wheaton, for instance. But yeah, there's a lot of opportunities out there. There's cash opportunities out there as well. The cash opportunities, not necessarily in the mining space, much more so in reprocess facilities, for instance, as well as recycling or reprocessing of tailings, things like that. So we're going through both those silos in terms of mining and non-traditional silver sources, but there's a lot of work that we're going through right now. And like I said, I was just on the phone before this meeting with a producer in Canada. So fingers crossed that we can keep knocking these off and we can add another one in the next little while.
Do you have a stated target for annual organic growth in attributable silver ounces or revenue per year?
We do not. We have not gone out and publicly stated that. I do say that internally, I myself like to see the doubling of silver ounces every year. We've done 350% year on year silver ounce growth since we started the company. So I think doubling is achievable. And ultimately, if we want to hit that 5 million ounce level, it would take us about 8 years from now to get there. So obviously, I'd like to see that happen a lot quicker. But that's my kind of internal growth rate. And generally, this will translate into another question. So I might as well preempt that one. And that is in terms of dividends and in terms of growth. Well, if we're doing 25, 30% IRR deals, it would take us 4 years, 3 to 4 years at a minimum to generate enough free cash flow to do another deal of the same size. If we pay all that out in dividends and then identify a number of projects that will double our revenues, we'll go out in the market, raise that money, or as I mentioned, our preference would be to utilize our equity or some combination of the two, but the preference would be to utilize our equity. So basically, another way to put this is, we have all the money that we need right now to get to free cash flow. There's not going to be any other raises until there's a very concrete use of proceeds on a definitive agreement for another project. And we're not going to be, I don't want to be issuing money down here or issuing equity down here at $5.50, $6. I would much rather do it a lot higher, not just for myself as a shareholder, but for all of my shareholders. Plus also, I think the stock is tremendously undervalued. And we can talk at length, cost of equity capital, the returns on capital, et cetera, and what our internal hurdles are. But right now, it makes very little sense for us to use equity to do deals simply because of how inexpensive we are at this price point, right? Which is why utilizing equity without raising it, but going directly to the vendor and saying, hey, let's do a deal at $8, $10, now it makes a lot more sense.
It has been suggested that the silver royalty sector is oversaturated with companies and not enough deals to go around. Can you comment on this theory?
There would be some, let's say, credence to that, validity, if we were to only look at one part of the market, which is existing royalties. Right now, what we discovered when we started this company was there's no such thing as a silver royalty. If we want the silver royalty, we will have to create it. And if you look at the space, nobody under $1 billion market cap creates royalties. All they do is they treat existing ones, they take royalties out of portfolios. There could be streams they take out of portfolios. So those things do exist. There is competition for that, but that is not a space that we play in. We only play in a space where we can create the royalty ourselves. It comes with those various protection measures that I described earlier in the presentation to protect our investors and our shareholders. So effectively, what that allows us as well to do is structure deals that are 25, 30% rate of return. If we were to compete in the space for existing royalties, which we're not interested in at all, but if we were competing in that space, the best return that I've ever seen on a royalty like that was 7%. The worst one was negative 2%. That's below our cost of capital. We're not going to do that.
Is the plan to stay in North America and South America?
Well, like I mentioned, there's 2,400 operating mines that have silver coming out with them. So obviously that's global, right? I mean, you're looking at Uzbekistan, Kyrgyzstan, Russia, all kinds of places. You know, some place that's safe today may not be safe tomorrow. And we've seen that in Argentina many times in our lifetimes. We've seen it in Chile. We've seen it in Peru. We're seeing it in Colombia to some extent now. Venezuela was okay in the late 90s, not so much in the early 2000s, definitely not today. And who knows what happens in North America as well under various political regimes. We don't really know. So the only way for me to correctly answer that question is every piece of capital deployment will not necessarily be based on political risk, but it's going to be based on returns and how much capital we're deploying into that specific area or region. If it's a place that today is wrought with risk, obviously Russia, we're not going to put any money in today because that's a pariah state. But let's talk about Sudan, for instance. Look, there's gold there, there's silver there, there's opportunities. Would we put 1% of our capital base into South Sudan? Probably not, but 0.5% with a 500% IRR. I mean, if I can get our money out in 3 months, 2 months, maybe that's risk worth taking. But every single capital allocation decision that we make will be this pragmatic in the sense that we're never going to put 20% into some project. And you know what? That could be in a safe choice. It could be in Nevada. But we just don't know what happens in Nevada in the next election cycle or in the next 5-10 years. So because of that, we will limit the amount of capital that goes into any given project, and we're going to try to get as much return for our investors as possible based on the risk that's associated with it.
As a royalty/streaming company, what is the rationale of allocating capital to holding physical silver and not in the investment in cash flowing or near-term royalty deals?
Look, the only time that we will have silver on our balance sheet is if we don't have an immediate use of proceeds. If we simply have working capital or excess working capital, we're going to park that in silver. And we feel that our investors don't buy metal companies, be they miners or royalty companies or whatever else, to get exposure to cash. I mean, any investor can do that themselves. But if I'm putting money into a producer that's producing gold, I would expect them to not have $1 billion worth of cash sitting on their balance sheet, getting eroded in terms of purchasing power over time. Either give me the money back in dividends so that I can do whatever I want with it, or hold it in the metal that you're supposed to be exposed to. And right now, I believe that we're the only royalty company. In fact, we may be the only, if you throw producers in there, we may be the only company that has physical on our balance sheet. Is it a lot? No, it's about 500,000-600,000 Canadian. But what it does is it generates returns that are above what we would get in a high yield GIC, which right now is running about 2.8%. So if we can park that cash in silver before we need it, absolutely going to do that. But of course, look, we're not married to that position. If we come across a project where we can immediately liquidate that silver and buy it back essentially through a producer at $10 an ounce or $15 an ounce, we're doing that right away.
Do you feel some consolidation is needed in the silver royalty space?
We're the only silver royalty company there is, so there really is nothing to consolidate. Do I feel that it makes sense to consolidate gold royalty companies? There's quite a few that are essentially dressing themselves up exactly for that eventuality. And again, like I said, if all you're doing is trading royalties that already exist, well, you're just kind of hoping that Franco or Wheaton are going to gobble you up at some point, or Royal Gold. And that's exactly what we've seen in the past. Very few companies, again, I don't think there's any under $1 billion market cap that actually originate royalties. We're the only ones, and we're the only ones that originate royalties on silver. Could somebody acquire us? Absolutely. And if that were ever to happen, shareholders get to vote on that. My preference would be to try to unlock value of the royalty company silver that approaches us simply by them having their silver revenues parked in us and taking a small stake in us for exchange of that silver. In my mind, that makes sense. However, again, if that bridge is ever in front of us and we are to cross it, that's going to be a decision for the shareholders.
What are the mine lives of your assets?
It's kind of a, let's say hodgepodge. No, it's a mix. It's a mix. The shortest one would be PPX, which is capped at 225,000 ounces, which would be roughly 4 years from when they hit their full production, which is expected Q2 next year. And the longest one that we have is perpetual. It's indefinite because it's a facility. It's not built yet, but once it is built, it should be with regular maintenance running for 100 plus years. So that's kind of the range. When it comes to mining projects only, based on various technical studies, outside of PPX, the shortest one would be 13 years and the longest one would be just over 40.
What market or balance sheet conditions would prompt you to add further physical silver to treasury holdings?
So ultimately, I would like to see 1 year's worth of working capital in cash on our balance sheet. So anything over and above that, we can use to buy silver. We've bought silver on pullbacks. Generally speaking, we tend not to chase the price. And that chart that I shared earlier in this presentation serves as a guide. Leaves us a little bit of extra room to purchase silver with if we so choose. But again, when an opportunity comes along that we need cash for, and we don't have enough in the quote unquote working capital bucket, the higher price silver will get exchanged for the lower price silver every time.
Would you ever entertain offtake deals from recyclers with other metals?
Absolutely, yes. And in fact, we've talked to a couple where we would be looking well, with other metals, no, they would have to have silver in the mix. We're not going to take iron ore or, battery recycled zinc or something. No, we're going to only take silver. So it would have to be post-consumer electronic waste or some form of that. Not sure if that answers the question, but yeah, we're definitely looking at recyclers and just on the silver part, but they are multi-element producers. The silver for them generally is in a 5 to 7% range of revenues. So it certainly fits with that, minimal economic impact side of things for us.
Thank you very much, Peter, for all of your responses today. If you did not get a chance to submit your question, you can reach out to the appropriate account manager here at Renmark. That concludes our presentation for today, but before we go, I will turn back the floor to Peter for final remarks.
Please do not hesitate to reach out. You can get in touch with us through our website, silvercrownroyalties.com. You can sign up for our distribution email there as well, phone number, email, all that stuff. If you want to reach out to me, ask additional questions, by all means. That's the best way to do it. Thank you.
And once again, this was Silver Crown Royalties trading on the CBOE under the ticker symbol SCRI and on the OTCQX under the ticker symbol SLCRF. Thank you to everyone in Atlanta and surrounding areas for joining us today. Please stay tuned for other presentations in your area and see you next time.